In this video, we will discuss current conditions on Main Street and Wall Street during the COVID era. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I'm currently a retirement strategist and portfolio analyst for FIFA and adjunct professor of finance and accounting at the University of Maryland Global Campus. In a recent Yelp survey, around 28,000 shopping and retail stores had closed down due to COVID, close to 24,000 restaurants, 15,000 beauty and spas, and approaching 6,000 fitness centers. Of these, by far the restaurants are the worst damage. Over half of them indicated they would never open back up. Over a third of the shopping and retail stores indicated they would never return to business, and around a fourth of the beauty and spa and fitness centers also indicated they were permanently out of business. The labor force participation rate, an alternative to the unemployment rate for looking at the strength of the U.S. labor force, has been decreasing pretty significantly since 2000, but recently dropped drastically with a little bit of a rebound. But now the percentage of the U.S. labor force is back to around in the 70s, before women completely participated in the labor force. Far fewer Americans are working, and it is likely that many of these will never return to work. If we look at the GDP in the United States, it recently had a quarterly drop on an annualized basis of over 30%, but with some recent rebound. If we compare this to all of the available historical data, in this case going back to the 1930s, we find this drop is even worse than that at the beginning of the Great Depression. One of these is GDP, one is GMP, but in the United States it's only a very small fractional difference. We can also look at earnings analysis of the S&P 500, and we can look at the decrease in earnings over the last year. First quarter of 20, we had around a 15% drop in S&P 500 earnings. Second quarter, over a third drop. Estimated third quarter, a 20% drop, and fourth quarter of 20, a 14% drop. So all of these indications are that the stock market should be doing badly because the economy is doing very badly. But this is not the case. The price to earnings ratio is the dollar amount you pay for a share divided by the earnings that share is expected to produce in the next year. So the inverse of this, the E over P ratio, would be the rate of return in fractions, rather like the rate of return on a bank account. So the higher this number is, the more enthusiastic people are in the stock market, and the more they're willing to pay for a share of stock. Now, according to the Shiller version of this, it's up around 31%, or only around a 3% rate of return of investments. This level has only been seen a few times in history, once at the peak of the bubble that burst at the beginning of the U.S. Great Depression, and then formally during the dot-com era. The Shiller P uses a long-term, I believe a 5-year earnings average, so it's going to look slightly different than other measurements of P/E. Another measurement of P/E, looking at the price divided by the trailing 12-month earnings, is also highly valued. Now we are quite a bit higher than at the peak before the Great Depression, and even above the level of a panic in the 1890s. We are at similar levels to before the dot-com bubble and before the housing bubble. It is worth noting that these peaks have been much higher since the 1990s than any time before in history, with the exception, again, of using the Shiller P/E right at the beginning of the Great Depression. So what has caused these levels of valuation in the stock market to be so much higher than they have been in the historical past? We will discuss in the near future. Another measurement of market valuation, the favorite of Warren Buffett, is the Wilshire 5000, which is a proxy for the entire United States stock market, although now it has less than 5,000 stocks, divided by the GDP. And again, this is at record levels, even above the dot-com level. So by all of these measurements, stocks are highly valued. People are very enthusiastic and willing to pay much higher than historically normal levels in the stock market. What has caused this is probably government money printing. Most recently, as soon as the COVID bubble burst and the stock market had a drop in March, the Federal Reserve doubled its monetary base from around 4 trillion US dollars to over 7 trillion US dollars, the biggest money printing effort in US history. This resulted in fear in the stock market, measured by the VIX, dropping drastically, and the run-up we have seen in stocks from February until now in August. So what has caused these big run-ups is the fact that there is no longer any restraint in government printing of money. If we go back historically, before the Roosevelt administration, at least in theory, there was a restraint on government money printing, because even after the Fed was created in 1918, the Federal Reserve was only supposed to print as much money as it had gold to back it. They, of course, didn't do that. They printed a ton of money since 1918, somewhat resulting in the bubble in the 20s that then burst at the beginning of the Great Depression, and then resulting in the default domestically on the gold standard in 1933 when President Roosevelt outlawed the individual ownership of gold. I believe individuals were allowed to own 5 gold pieces. Most of the gold held by banks was seized by the federal government and deposited in Fort Knox under federal control. So if we look at the general price level throughout history, it's been largely stable until the creation of the Fed in 1918. We did have little bump ups, inflation during the War of 1812, when the Central Bank of the United States printed money to finance the war. After that, the central bank was retired, in a sense gotten rid of, and we had pretty much no inflation until the Civil War, when once again Lincoln abandoned the gold standard and printed money to finance the Civil War. Those greenbacks were again retired, and the U.S. was largely on a gold standard from its founding until the creation of the Fed in 1918. Then again, even though they were supposedly restrained by only being allowed to print as much currency as they had gold to back, they did not honor that restraint. They printed quite a bit of money, resulting in the bubble that created the Great Depression. That burst, and we had an interwar period. And then after World War II, something called the Bretton Woods Agreement was created. Individual Americans were not allowed to own gold, but the central banks of the world were tied to gold. So the idea of Bretton Woods was the British pound, the Japanese yen, the German mark was tied to the US dollar. The US dollar was supposed to be restrained to be exchangeable for $35 per ounce of gold. Once again, the central bank did the same thing as they had done in the 20s, and they printed way more gold, or way more money than they had gold to back it. During the 1960s and early 70s, the other governments of the world started to call the U.S. on this. The French in particular kept bringing in dollars and exchanging them for gold. This was done at the New York Fed. If you go to the basement of the New York Fed, there are a bunch of jail cells filled with gold, so the French would bring in dollars. Gold would be removed from the U.S. jail cell and moved to the French jail cell. Well, eventually, the U.S. just defaulted on that, said we are no longer being on the gold standard, and after that time, the various world currencies started to float against each other, and government money printing went completely insane, resulting in the inflation levels we see today. There are many that will ask, if all of the money printing is supporting the stock market, why isn't there a ton of inflation in the U.S. economy? Well, since the early 1980s, the CPI has been changed in the way it is calculated at multiple different time periods. In the 1980s, taxes were indexed to inflation, the tax brackets, to supposedly get rid of bracket creep. Somewhat before that, the Social Security Administration was indexing Social Security payments to the CPI. All of these things were costing the government money, so they had a pretty strong incentive to redefine the CPI to understate inflation so they could raise more money in income taxes and pay out less money in Social Security. Some of those changes engaged in was changing the housing to the owner equivalent rent, going to a basket of goods system, where if steak prices went up, the CPI would say they really wouldn't go up. You'd just switch to eating hamburger if that didn't go up. And also putting in hedonic corrections, where if this year's car is nicer than last year's car, even if it's more expensive, it's really not because it's a nicer car. So you put in a lot of corrections like this, and you go from this measurement of inflation, which today would be around 7%, to this measurement of inflation, which is 0. This is produced by shadow stats, which are people who are somewhat cynical about the way inflation is calculated. So in likelihood, official inflation understates inflation, and you can read more about this at shadowstats.com. So what does all of this information tell us about how to invest in the stock market and what the possible future of investments are? Well, another bit of data that we can look at is presidential election cycle theory. The idea behind presidential election cycle theory is presidents, particularly incumbent presidents, want to get elected, have quite a bit of power over the economy. For example, President Trump has pressured the Fed to print a lot of money, even suggested negative interest rates. He has supported payments to those that are currently unemployed due to COVID. He's even done an executive order to try and continue these payments. And all of these efforts will attempt to stimulate the economy and keep the stock market up through the end of the election year in November. And this, hopefully, from his point of view, will get him reelected. After the election is over, obviously, it will not be as important to President Trump. Similarly, if President Trump was to lose the election and Joe Biden got elected, the first few years of his presidency, he could blame any economic problems on President Trump. So the result of this is what we see the year after a presidential election. Historically, the S&P 500 underperforms. The average rate of return since the 50s is close to 11%. Average rate of return in election years is 6.5. The other years are higher. Generally, the third year is the highest. So we might expect after the election year that the stock market will underperform in 2021 or even have a pullback in 2021. Historically, we have seen that the only way in a passive investment to make money is through stocks or maybe possibly real estate. The dollar, since the Fed was created in 1918, has dropped in this graph down to only 5 cents of value. If you continue this, it's down to less than 1% of what it was valued in 1918. Gold has largely kept level with inflation, so buying some gold at this point as a hedge against inflation might not be a bad idea. It's an insurance policy, but over the long run, it's not going to make you any money. Stock or bonds and bills have made a little bit of money until, again, the Fed was created. Since then, they've largely just kept level with inflation. So while stocks are heavily overvalued, to some extent, they're the only long-term game in town. But what kind of stocks does one buy? In recent years, so-called story stocks have done the best. .com stocks like Amazon have in particular done very well due to a further shift from people buying in stores to people buying online. The price to earnings ratios of these kind of stocks is even way higher than the general S&P. And these stocks have outperformed what we will call value stocks for around the last 10 years. But historically, this is not normal. If we split up the stock market into these so-called growth or story stocks and the value stocks with the low price to earnings ratios under value, the high price to earnings ratios under growth. Well, historically, if you go back long enough, the value stocks have drastically outperformed. Currently, they have way underperformed. But if we have problems in the stock market in the future, these are likely to be safer investments than the story stocks. We can look at a graph of which has done better during which time period. Again, in recent years, the growth stocks, the story stocks have done better, but for very long periods of time, the value stocks, which you might look at, not great companies, but at a very cheap price, as doing better. So the way of looking at this is a Mercedes is a fantastic car. Would you pay $1 million for it? In all likelihood, the story stocks are being overpaid for, and at least the value stocks, while the market is overvalued, are not overvalued nearly as much as the growth stocks and are probably a better investment. Since market timing is very difficult, I would not advocate getting completely out of the market, but again, value stocks historically have had a higher rate of return at a lower risk. Here we have an average total return including inflation of 13.7 for value, 13.2 for growth, with a volatility of 20.4 for growth and only 15.7 for value from 1980 to 2014. So in summary, how should one invest under these market conditions? Well, it's very difficult to time the market. It's very difficult to determine when a bubble will pop. It's also possible that the Federal Reserve will just keep printing money so much that the stock market will keep going up for the foreseeable future, although historically this seems unlikely. So how does one invest? What I would recommend is avoiding the story stocks, even avoiding the S&P, and instead going to value funds, funds that invest in the low price to earnings stocks in the S&P or the broader market, the Wilshire 5000. Possibilities are the Invesco S&P Pure Value Fund, ticker symbol RPV, iShares Russell 2000 Value, IWN, are a whole series of Vanguard funds, all of which are very low-cost investments. Here we have two with high dividends, one domestic, one international. It is also possible, there is historical evidence that small cap funds outperform large cap funds, so a small cap value fund could over the long run be a very good investment. That is VBR, and there's mid cap, again, which is at least smaller cap than the general market at VOE, and there's the Vanguard Value Index Fund that includes all of these stocks, VTW. One could also look through some of these high dividend plays, our value, small, mid cap, or large cap stocks, and pick out individual stocks you like. I believe it is likely that all of these type investments will outperform the general market, and if there is a market downturn, at least go down less than the overall market. I thank you for watching this video.